Diversification can take many forms, and it's not just a topic that long-term investors need to understand, it's a technique that also applies to short-term traders. Get this right and it can help significantly with the objective of increasing your reward to risk ratio. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. This episode covers several related topics, all necessary to fully understand and incorporate the concepts of portfolio diversification into your everyday trading decisions. This includes different diversification techniques, measuring and the principles behind using correlation, balancing risk across portfolio components, all with the purpose of increasing your reward to risk ratio. So let's make a start. As I said previously, this will be the last episode of this particular series on trader evolution. And this is a slightly more advanced technique than some of those that we've looked at, and is something that when a trader gets to this competent trader and they start to make profits, they're going to want to pay particular attention to in order to take them to the next level. And so issues faced at this point in time are going to be around high levels of portfolio correlation, where multiple assets being traded have high correlation between them, which adds risk. And so the different activities that might be pursued at this stage is looking for how to correctly diversify across asset classes, assets, maybe even timeframes, and certainly trading strategies. And this will all be part of a risk management overhaul that this trader now feels they need to make. Now, in this episode, I'm going to be covering at a very high level some of the major topics that I feel are going to have the most impact on traders. But as some of you will be aware, I've covered these topics in a lot more detail previously in their own series. So what I'll do as I go through each of these topics is provide information about which videos you can watch to dig into more detail around any of the subjects. So in order to get a good grounding into the concepts of diversification, I have a video that will introduce you to this. And this will talk about the concepts of how you can construct a portfolio in such a way that it reduces your overall risk. And one way of looking at this is something that smooths out the drawdowns in your equity curve. And that, of course, is in comparison to a trading strategy that you're using on those individual components. And one of the main takeaways from this episode is the example that I provide, which shows how the two equity curves from individual assets can be improved on significantly by trading those two together in the same account. And although a very simple example, it really does illustrate the power that diversification can have. So for this first episode, you can click on the link that's appeared right here. I've set up all of the links in this video so that they take you to the playlist. And what that means is that when you see the video in YouTube like this, on the right hand side you'll see a list of all of the other videos in order, and so if you choose to watch these from beginning to end, you'll be able to do that very easily. Now, these are part of the Algo Trading for a Living playlist, but if you want to focus purely on the diversification part of this, then you'll need to start at episode 29, which you can see at the top of this list here. Okay, so I mentioned there were multiple ways of achieving diversification. And one of the main techniques is to diversify across asset classes. And what do I mean by an asset class? Well, for example, stocks or stock indices, futures, FX or commodities. These are all different classes of tradable assets that will usually have a good low correlation between them. And in this particular video, if you want to take a closer look, I show an example of trading an FX currency pair with the commodity gold and trading those in the same account to get those benefits of diversification and hopefully to smooth out that equity curve. Again, to go straight to this video, you can click here. Episode 33 then looks at diversification within an asset class. And as long as you're measuring the correlation between the assets in those classes, this can provide significant benefits. A word of caution. This is not always possible within an asset class because sometimes there are high levels of correlation. So for example, all of the stock indices tend to have an extremely high correlation, somewhere between 0.8 and 0.9. And so this just isn't an option in those cases. However, when you're looking at Forex and different commodities, there will be plenty of opportunities to do this. And so I give an example here of diversification in action by showing the benefits of trading 3 currency pairs in the same account. Now for this and the remainder of the videos, I'm not going to put links that appear on the screen, but you can access all of the links from the YouTube description right below. And in there I'll have one link for each of the episodes that I'm talking about, but just the same as before, each of these links will actually take you to the video within the playlist, and so you'll have this handy list here of all of the episodes so that you can choose which ones you want to view. Episode 34 talks about the concept of diversification across different time frames. And although many traders would see diversification as being a technique for assets and asset classes, this is an additional excellent technique to spread your risk exposure even further. And once again, I provide a good example of the benefits that time frame diversification can bring. Episode 35 then looks at trading strategy diversification. And this is one that you're definitely going to want to do. And the whole basis of this is that when one category of trading strategy is performing well, there might be others that are not performing so well, and then vice versa at other times. So using the simple example of a mean reversion strategy and a momentum-based trend following strategy, this can perform a vital role when you're trying to reduce your overall portfolio risk by trading those two strategies in the same trading account. Episode 37 then moves on to the subject of balancing the risk across the components of your portfolio. And this video covers a number of techniques that you might want to consider, ranging from the very simple up to some more complex ideas around institutional grade risk balancing techniques, and take account of things like inter-asset correlation, the volatility of each of the components, the alpha generating potential of those, in order to inform a balanced portfolio. Now, I mentioned earlier on that this will be the last episode in this particular series, but interestingly, the next series is going to cover this topic in a lot more detail, which I'm calling institutional grade risk management techniques. In order to properly inform these types of techniques, we need to be able to manage and measure the correlation between the individual components being traded. And I go into this in a lot of detail in episodes 38 to 43. And the reason we do this is that we have to be sure that the components we're trading are not overly correlated. And so regardless of whether you're a discretionary trader or an algo trader, this is a technique that you have to be familiar with and have to be comfortable using to inform your own trading decisions. And across these 6 episodes, I'll teach you all of the core concepts and techniques that you need to know. Okay, so that brings us to the end of this series on trader evolution. But as I said earlier, next we have a new series which is going to be all around institutional grade risk management techniques. And this follows on really nicely from this video where we talked about some of those concepts at a high level, but in this new series we're going to get into the real detail of the subject. Now, if you've got benefit from this series, I'd really encourage you to give me a like, leave comments on the videos, because I really do love to read the feedback I get from viewers. Now, I don't have time to respond to all of those, but every single comment does get read. So remember to keep an eye out for that new series, which should be starting in the next couple of days. And if you subscribe to the channel, then you'll get notified when that gets released. But until then, trade safe.